Good morning, 9:05, July 30th. Uh, it's Hawaiian time. I'm back in Kauai. I just took one day break from recording this podcast, and we had so much happen. I woke up about 5:30 this morning local time today. We had the Fed yesterday, which was crazy. We've had the Leopold unwind. It the Citadel buying of his portfolio, rumors that he sold half of Anthropic. It is amazing. The daily volatility and the things that are happening reminds me of the late 90s, 1998 long-term capital management. This is what the situational awareness reminded me of. I was actually going to record a podcast last night. We're back in Kauai, by the way, Kauai for the local Hawaiians, my favorite of the Hawaiian Islands, although they're all terrific. And I was going to record a podcast last night, and I was going to do the title was going to be "You Can't Win," and I was thinking of Rocky, of his trainer Meredith Bridges, who played him in Rocky 3 when he's going to fight Clubber Lang. He says, "You can't win, Rock." Adrian also said that to Rocky in Rocky 4 when he's going to fight Ivan Drago. And the reason I was thinking of that is with the market. At one point here, we got to over 50% of the S&P 500 that was trading at 10 times sales. Remember the famous quote from Scott McNeely in 2002 when he was looking back and he said, "You can't make money as an investor when a company's trading above 10 times sales." And then SpaceX came at IPO'd at 100 times price to sales. So you can't win here as an investor in a lot of these companies. The best that you can hope for is you go sideways and everybody just thinks you buy the market and it goes up over the longer term. Nobody knows what they own today, though, because everybody that has been an active investor, a fundamental investor, has been basically sidelined in the market. And so you're getting just fund flows and price insensitive and valuation insensitive fund flows that are driving everything. And then people trade around that. But there's this cohort of the market, it's a huge percentage of the market is trading at extraordinary valuations, much higher than what they were in 2000 or 2008. And I think that's lost upon people that trade stocks. We'll get to more of that tomorrow. I'm going to do a "You Can't Win" podcast, but for today, I wanted to recap the Leopold blow up, the Citadel buying of the assets, the Fed, Kevin Warsh is a monetarist, and then I want to talk about a few individual stocks. Leopold, it's going to go down as an amazing story. Um, he graduated Columbia University at 19. I'm just reading from some notes I made here. As valedictorian, he signed an 8-figure contract at OpenAI. He wrote a 165-page prediction about AI and got fired. The essay starts coming true. He raised $200 million to invest in the thesis, and he had an incredible run up. It's rumored that he was using over 400% leverage, and part of his stake was a stake in Anthropic that was private. We've had the biggest momentum turn down in market history in a single month, bigger than anything we saw in 2000 or 2008. And it's perplexed a lot of people because the S&P is pretty close to its highs, just a few percent from its highs, and the equal weight S&P just made a new high just recently, the RSP. But when you dig into the under the surface of what happened with Leopold and his fund situational awareness, you can start to see what's going on. And Leopold was short things like Adobe, which was a software company, and Adobe's up a lot this week. He was long things like SanDisk and the uh, data center plays like CoreWeave and iRend and Nebius. So as those were unwinding, his longs were going down at a precipitous pace. His shorts were going up. And there's an old saying, there's a quote um, that when you're down a lot in the market, and it comes from when long-term capital management was down 50%, the founders there said, "Hey, we're okay. We have $2 billion more in capital." But there was a market commentator, famous investor at the time, that said to them, as soon as you're down that much, people are going to sense the weakness in the market and they're going to go for the kill. So who went for the kill here? It appears Citadel, and Citadel is Ken Griffin, the man behind Citadel, is famous for this. He he when Enron went under, he flew a plane to Texas and basically interviewed the participants in the Enron trading and hired some of those guys. He tried to hire John Arnold. John Arnold went on to be a very successful natural gas trader, but that was the genesis of Citadel's commodity business. So here again, Citadel's a market maker. Ken Griffin and his company are one of the heavyweights of Wall Street. They're attuned to what's going on. They are the buyer of situational awareness stocks, all in a single trade, and then they can go out and hedge against that and unwind those positions or do whatever they want to do. But it's an amazing the rise and fall of situational awareness. And Leopold, I guess he was getting married. He's a younger guy, um, still successful in many respects, but the market is crazy, and it there's still details coming out on this. I don't know if Leopold has been absorbed into Citadel, if there's not competes. I don't know what percentage of the Anthropic stake that situational awareness will retain. So there's a lot of things that you're getting reporting on, but it's really a remarkable market development, and it speaks to position sizing, being careful with leverage, and you have to be cognizant of what can happen in a drawdown. So again, this reminds me of long-term capital management in 1998. I don't know if that says anything about where we are in the market cycle, but the daily volatility has been extreme. The individual stock volatility has been extreme. The index volatility has masked a lot of that, and you're seeing big moves in individual stocks, but sometimes they offset each other. With all this that happened, it made what happened with the Fed yesterday kind of take a back seat, and they didn't raise rates. And tying this together, it's a nice link. But Citadel had, who Ben Bernanke is an advisor for, had came out just a few days ago and said that the Fed was going to hike rates. Remember, Kevin Warsh left the Fed in 2011. Warsh is a monetarist, and I have a lot of background in that too, a lot of background in Austrian economics. You can think of Milton Friedman as the famous monetarist, and I've got all kinds of degrees and schooling and designations and that I had and don't have them at different times. And I've studied under some of the truly remarkable market historians, and I really appreciate that. But the monetarist school, they were discredited after the Fed did QE in 2009, and people thought that that would bring inflation. It didn't. There's a lot of reasons looking back to why that did not happen. I think part of it is you had these giant dominating monopoly type companies that had a disinflationary impact, and they dominated 6 or 7 different business arenas. There was a huge inflation deflation debate. I was actually invited to a panel with Mark Faber, Gary Schilling. There was a billionaire investor in New England that had us out to his farm, his property. There was a barn. There was a debate on inflation and deflation circa 2011. You didn't have inflation that came out of all the money printing back then. And the monetary school of thought was kind of discredited. And we had low interest rates for much longer than people anticipated. And the expansion of the Fed balance sheet didn't lead to runaway monetary inflation. So when you get to 2020 with COVID, they kind of doubled down on that playbook. But this time, the response is far different. The inflation that people were looking for back in circa 2009, 10, 11 surfaces. Now they have to raise interest rates or the Fed is behind it. And so the monetary school starts to gain some credibility again. So think of Kevin Warsh, he's from that monetary school. what he outlined in the Fed meeting the other day was that he wants to. He said it without saying it, but he implied that, and he said this prior to his nomination as the Fed chairman. He wants to shrink the Fed's balance sheet. He believes that that's led to runaway asset price inflation and distortions in the economy. So, and he notably said in the press conference that the market has done some of the work. So the yield curve has steepened. It was some people, it's funny because there's so much going on. The Fauci press conference where he now has said 111 times that he's not going to respond on the advice of his lawyers. He's pleading the fifth. You have the Fed going on, and Warsh isn't giving a traditional press conference. He's basically he's cut communication. He's cut the wording in the Fed statements. He wants to let the market breathe and have flexibility, and he wants to shrink the balance sheet. What does this mean for the markets? I think that the incredible run you've had in growth over value from 2009 to 2021 was the first peak with the SPACs and the IPOs. Now you've got a second echo peak with the NVIDIA-led AI trade. Have we peaked? I don't know. I mean, again, it could be like long-term capital management. The unwind of situational awareness could be a blip. We could go higher. However, valuations are at extremes. At one point here, over 50% of the S&P 500 again was trading at a 10 times price to sales ratio, which again, that was the demarcation line where Scott McNeely said you just can't make money at that point. So think about that. That was, one or a few companies in 2000. Now over 50% of the S&P 500 is trading at those valuations. Nobody cares. It doesn't matter right now because the guys who do valuation work have been again thrown out of the markets, and it's creating what I believe is the golden age of active investing. Though I think it's been around since 2020. The volatility now is also another sign that we are in this amazing period for active investing. You're seeing it in stocks. There's a tremendous bounce today in things like Bloom Energy, the semiconductors, SanDisk. Microsoft is up a bunch after they reported. That's been one that I've been pretty good timing on the buy side. Adobe's down though because you're getting an unwind of the unwind that you saw the last few days. So what does this mean if you're watching this as an investor? I think you have to look at the markets and say, I have to be cognizant of what is going on, where valuations are. We've had this tremendous run in growth and in large cap growth, but valuations now are greater than they've ever been in modern market history. Correspondingly, risk is very high. Doesn't mean you won't be able to make money because it's very much a momentum market and a trend following market. So you're going to get tremendous volatility. If this last month, July of 2026, was the break that we saw in March of 2000, when the tech market broke in March of 2000, it wasn't a straight move down. You got violent rallies in that bear market. You remember the Nasdaq Composite went down 78%, but there was I had written a piece. There was just numerous, over 20 rallies in that were significant. I want to reference that in my next written piece. So it won't be even if this is the top, and we don't know, this might be long-term capital management all over again, and the market goes down to make new highs. There is tremendous breadth, strength in the markets. You're seeing a rotation of value, but again, you have to be cognizant of how big, if it is really a top in these semiconductors, which are a huge part of the market, and large cap tech, they dwarf in terms of market capitalization, enterprise values, what's on the other side. So if there's rotation, there's not enough space for capital to go into, and obviously with leverage, you're going to see an evisceration of capital too. So be careful. The volatility is for a trader, it can be very good. If you're a long-term investor, just know the backdrop, know where valuations are, know the risk, and it's very likely, just like we saw in 2000 to 2010, that large capitalization stock at the end of 2099 was Microsoft. It went down 70% twice. It was down 70% at the end of '02 and '03, and then it was also down 70% from its highs, 99 2000 highs in March of 2009. Took 15, 16 years to get back to even. The indices went nowhere for 10 years. You saw that in 1968 to 1982 with the Dow, where the Dow went from 1,000 to 1,000, but you had a lot of inflation. So the return to real investors, or real return to investors, was real. The real return people lost, even though the Dow went 1,000 to 1,000, people lost 80% of their money. So, but the 70s, 1968 to 82 was the Dow 1,000 to 1,000. The 70s were a great stock picking environment for active investors, for commodity investors, for value investors, for small cap value investors. The same thing was true in 2000 to 2010. Terrific environment for value-oriented investors, for stock pickers, for active investors, for commodity investors, for value investors. It looks like we may be on the cusp of a regime change. Time will tell. I'll do my "You Can't Win" podcast tomorrow, but you get a preview of it today. Take care. I'm just jerry rigging my backdrop here. I used the chair and the table to prop my computer up so I can record the podcast. Thankful and grateful for all in our group. Take care. Bye.